conversation with Cummins. Their Q4 numbers, which came out, had a fair degree of headlines, if you will, while revenues were largely in line with most estimates, and there was a gross margin miss. But EBITDA had a big beat, much higher than what the consensus estimates on Bloomberg were. There is also a lot of conversation around what could happen in FY24, considering that on the day of the results, because of a bunch of moving parts, there is no formal guidance given by the management for FY24. And therefore, it will be pertinent to speak to Mr. Ashwath Ram as he joins us today about what does he feel about business, what did he think about Q4 as well, what led to that margin beat, and what could FY24 hold in store. Great having you, Mr. Ram. Thanks for joining in. Hope all is well.
Everything is great, and things are actually looking quite positive from where I sit.
Awesome. I would love to probe that more. Can I just first talk about maybe Q4 and FY23 as well? Because the standout part to me in the quarter was the EBITDA beat, despite the fact that gross margins did come off a little bit in Q4 versus Q4 last year. So a word on Q4, the revenue numbers, and more importantly, the EBITDA beat.
Yeah, the Q4 gross margin reduction is mainly because of the mix. And when we look at the mix, what we mean is we had these one-time PDI sales, which are big sales of some equipment which is just imported, and Cummins India just gets the commission on those. So those are they end up being at a lower margin. The second very big portion is that construction sales were a lot higher in this quarter versus the equivalent earlier quarter, and construction sales also tend to be a slightly lower margin, and sales of defense, industrial, and rail were lower. Those tend to be at higher margin kind of products. So I think those were the biggest reasons for gross margin drop as compared to the previous cycle.
Okay. A word on the composition of the revenue, both in imports, rather domestic sales versus exports, because for a few people, the exports were a tad bit lower. Does that also play a part in how the gross margins perform in a particular quarter?
Not as much, because while they were a little bit lower, they were proportionally, very similar to what we had forecasted. And okay. Q4s typically tend to have lower domestic as well as lower exports, because people come off the Christmas break, and exports business really doesn't start picking up till the middle of January. So you lose out nearly 2 weeks of the month, and then you're just playing catch up for the remaining part of the quarter.
Okay. So if you and then of course there was a EBITDA margin beat, I reckon, because of lower other expenses, lower probably employee costs. So two questions rolled into one. One, do you reckon that that's a bit of a base, if you will, or it'll keep on fluctuating quarter by quarter? That is part one. I mean, there's other expenses and the employee cost piece that I'm talking about. And two, when you look at the consolidated EBITDA margins for FY23 and the operational metrics that you clocked in, did they largely come in as per what you estimated, or do you reckon you could have done better?
The EBITDA came in as per our expectation for the full year. We have been working on structural costs for now more than 3 years. If you look at our numbers and you look at the percentage of where our SAR has been versus where it is today, we have structurally taken out cost and managed cost pretty efficiently, and that is what has been giving us improved profitability, despite not having lost some leverage in this quarter. And if you look at it year on year also, you will see that percentage of our SAR is lower than what it used to be historically. So I think just that structural work, we continue to hold on to the gains in cost. We are working pretty hard to not let it creep back up. And then holding on to prices as well as the continued positive trend on commodities. The combination of all of those has resulted in better profitability.
Interesting. So a word on that. So therefore, would you reckon that you'll be able to maintain these? I'm talking only the margins, and then we'll come to business outlook. But just the margins per se, do you reckon you'll be able to maintain these in FY24, or is there uncertainty because of the fact that CPCB IV comes into play from, I believe, July 1st?
Yeah. So there's always uncertainty of some form or the others. But as management, I think we have openly stated that it's our aspiration to grow at 2x of the GDP and continue to improve profitability by 100 basis points year on year. Now, all of that, while it's good to say, has been true when we were at the 15, 16 kind of percentage level. Now that we are closer to the 20 percentage kind of level, it's getting more and more difficult to hold on and keep getting incremental profit. But that's our endeavor, and that's what I guess management is paid to do, to try to come up with the ideas and the ways to be able to do that.
Yeah. Okay. So let's assume that you will be able to manage and maneuver with your ideas the operational metrics. Now I come to pricing, Mr. Ram. And I think this is something that we discussed back in Q2 or Q1, but now that we're on the throes of it, since CPCB IV comes into play from July 1st, but you have an overlap because you can do CPCB II. I presume that all the inventory is not out of the window, and therefore my question is, if CPCB IV is arguably a higher cost and a higher price product, but if CPCB II is available at a lower price, I presume, how easy would it be for you to pass on the increased cost of CPCB IV at a higher price to consumers when CPCB II products are available at a lower cost or a low price?
Yeah, and it's impossible to do that because we expect CPCB IV prices to be higher by 20 to 50%.
Wow.
Which is why we are experiencing the pre-buy. And the pre-buy is there because by CPCB regulation, while as a manufacturer, we stopped making CPCB II product on July 1st or on June 30th, the end consumer or the distributors can sell the product all the way till December 31st. So they are trying to purchase as many products as we can produce and stock them and then continue selling them till December 31st. In the meanwhile, we will gradually ramp up the CPCB IV production, and those customers who are not that price sensitive, who for product which goes into long-term capital projects, etc. I think those kinds of customers will start transitioning to the new product from July itself.
Could it happen? I'm trying to understand. Could it happen that there is niche buying that happens from July to maybe December, and then the full-scale proper buying would start from January?
I think that is the hypothesis because of which there's uncertainty, because of which we are not able to predict very clearly, and it depends on different markets and on different financial conditions as well. There are some markets where, like in the automotive market, the cutoff date was instant, which means the day you did the emission switch, you had to stop selling the old product. In those cases, we did not see any dip in demand because the underlying economy was continuing to buy the product because it needed it. Similarly, in this case, because there's such a long overlap and there is so much time, we do expect the pre-buy to have some impact on that, but we expect gradually for it to start scaling up.
Okay. Fair call. Well, so I'm guessing you would have been asked this on the investor calls maybe 5-6 times in different ways, so I won't add the 7th time, but it could well be that FY24 is a year of consolidation.
It's a year of consolidation, but it's only for the power generation market. So, and that also for the domestic power generation market, and that also below 800 kVA. So, I think that portion of our business, even if that were a consolidating response, and let's assume the market does not grow there because of all of these uncertainties, we still expect the other portions of the market that we continue growing the way we have. So we do expect to grow this year as well.
Okay. Now, and therefore, I'm trying to now come to the crux without getting into necessarily numbers, Mr. Ram. How do you feel about business? Because you started off this interview saying that from where you're sitting right now, things are looking positive. Now, please tell us, why is that the case? What is it that you're looking forward to?
Yeah, every time there is transition of technology and we move from a lower technology product to a higher technology product, around the world, we have seen that Cummins has benefited because we have technology which we have deployed in multiple markets around the world, as well as in multiple market segments. We are already ready with those technologies. Those technologies mean greater scope in terms of growth and value that we bring to the table, and opportunity to differentiate from competition. So all of those means it gives us a window by which we can perform better than when we were just selling a commodity product versus competition, and then the only differentiator becomes price. So we are entering into this kind of new era which gives us that advantage. Second is that global economies also continue to grow, and we have established a cost and competitive position in India which allows us to be extremely competitive, competing against everyone in the world. And that gives me the confidence that the export story is not over, or it's not that we have peaked, but that this is just another step to for us to move forward, or increase the opportunities even more than what they've had in the past. And the same thing is happening in multiple markets. It's happening in the industrial market. It's happening in the mining market. It's happening in construction. So everywhere we see that there are more opportunities for incremental technology. There's consolidation happening in the technology space. India continues to spend a lot of money on infrastructure, which plays into our sweet spot of what we do. So the combination of all of these activities, presents a positive outlook for Cummins as a company.
And based on that answer, even if FY24 is a soft year from an export perspective because of the Western demand still being uncertain, I presume here, based on what you're saying, the export opportunity remains pretty high, because would probably even pick up from where it is right now, say 12 months out.
I can absolutely say that exports will continue to grow. Whether it grows in the exact quarter is little difficult to predict, because the cycles are playing out differently in different regions around the world. But if you look at the broad trend year on year, I think the story remains positive for Cummins exports from India, and Cummins' share of exports in the global scheme of Cummins. So I think for both of those, the opportunities are actually increasing.
Wow. Well, that is great to know. Mr. Ram, the other piece is this whole conversation around the Capex boom, which currently is a government funded, a government led, and select very large private sector players, but not everyone onto the bandwagon as yet. Now, the point is, the net FDI numbers into India have only trickled lower from FY21 to 22 to 23. But the headline announcements around Capex plans of large global as well as large Indian players are fairly robust. So can you tell us from your experience as to how is the story looking as things stand? And is there promise of this improving materially over the next 24 months? And therefore, does it mean strong growth for a market leader like you, or is it difficult to pencil in?
Yeah, I always draw the analogy to what happened in China between 1990 and 2010. As that country began investing in infrastructure and in creating and growing its own economy, it created 20 years of continuous growth for businesses like Cummins. Because they built the infrastructure, they scaled it up, they built buildings, they built factories, they built capability, they created jobs, and they created growth. If we continue with our aspiration and the trends that we see, this 6 to 7% growth, which can only improve, it can't get worse. If we continue this journey of wanting to be a top 3 player in the world, I think we have to undergo a similar kind of infrastructure journey. And every aspect of that infrastructure journey is good for Cummins from a growth perspective. So I remain, while quarter on quarter, I remain cautious, but from a medium to long-term perspective, I'm extremely optimistic that the opportunities are just increasing.
Are the sound bites from potential or current customers giving you that feel about this picture looking as rosy?
Yeah, so I'll give you a few examples. So
please,
if you look at the coal ministry, they say we are at record levels and we are going to be digging for more coal. We are increasing coal capacity. So if you're increasing coal capacity, you need equipment, you need mining trucks, you need excavators, all of which use Cummins equipment. If you're going to build roads, if today we are building 25, 30, 35 kilometers a day, and then we are going to take it to 50, 60 kilometers. We are going to build more super highways. You need construction equipment. At the peak of the China economy, they were building 150,000 excavators a year. And in India, the best peak we have seen is we built 24,000 excavators a year. So I think there is a huge headroom. And when you build roads and then when you build the infrastructure, automatically the demand for trucks to move goods, the 1.4 billion people that we have are all increasing their aspiration for more and more products. So you have to move those goods and services to them, and all of that requires that the economy keeps going in the places where Cummins is at. So, I think I'm pretty pumped up over where we are going as a country.
Wow. My final question, what about competitive pressures?
Competitive pressure will always be there, but like I mentioned earlier, every time the technology becomes more complicated and more sophisticated, the opportunity for Cummins to increase our differentiation gets better. Because we are not present only in India, we are present in 146 countries around the world. We are a 100-plus-year-old company. We continue to invest over $1 billion in R&D, and out of which nearly 30% of that R&D is done in India. And we have tremendous scale and technology that we have set up within the country. And so that, yes, there will always be competition. And I think with these advantages, we have ways of differentiating from them.
All right, Mr. Ram, good to know this. We wish you all the best for the next couple of quarters, at least at the very least, because there is a bit of an uncertainty there. But would be lovely to exchange notes at the end of quarter one or quarter two to try and understand how is that transition phase shaping up.
Absolutely. We'll be glad to do so. And again, thank you for the opportunity. I think quite an exciting time coming up from our perspective.
All the very best for that. Lovely to know that. And thanks for joining us today. And viewers, thanks for tuning into this conversation.